Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures are falling after the latest read on inflation came in hotter than expected. We're talking about producer price index data for July. It showed that U.S. wholesale inflation accelerated last month by the most in 3 years, driven by a surge in the cost of services. The latest data throwing some cold water on Wall Street's bets on interest rate cuts in September. Plus, Bitcoin hitting a fresh record high. The digital currency touching $124,000 per token amid the risk-on rally. And smaller competitors like Ether and Solana are trading near records as well amid growing corporate adoption. Plus, earnings continue to roll out on Wall Street, watching results from the world's biggest farm machinery maker, Deere. Shares there falling after the company pared back its outlook as struggling farmers pull back on spending. The farm machinery sector had been expected to bottom out this year, but lagging demand for crops amid President Trump's trade wars continues to weigh on the industry. Let's get a check in on stock futures right now. We had seen futures higher, then that PPI data hit, showing that wholesale inflation coming in hot, and we saw a sharp leg lower. So right now, all three major averages are indicating a lower open here. The NASDAQ taking the biggest hit of the three. It's off by 0.5%. So we'll see how that plays out going into the cash open and then throughout the session. Let's dig into those top stories of the day. That hot inflation read, the producer price index showing inflation rose much more than expected in July. Still, stocks coming off another day of records with the S&P and NASDAQ. They closed at new highs. Are rate cuts still on the table? That is the question on investors' minds. Joining me now, senior reporter Ali Canal live at the NASDAQ and our Federal Reserve correspondent Jennifer Schonberger. Jen, I want to start with you and that wholesale inflation data, which is a bit of a shocker.
Yeah, it was definitely much hotter than expected by a long shot, right? Look at those numbers month over month, 0.9% versus 0.2% that was expected. So prices certainly heating up for businesses. The question now is, at what point does this translate over into CPI, right? Will businesses be pushing those cost increases onto consumers at some point? I'm also looking at, we know that the Fed looks at the personal consumption expenditures index, and today's report, PPI, in conjunction with CPI that we got earlier this week, our data from both reports are taken together for that PCE number, which we'll get at the end of the month. On its face, I would expect PCE to warm up based on the PPI data that we got this morning. I just got a note from Capital Economics. They are estimating the 3-month annualized rate would jump back up to 3.2% from 2.7 on core PCE. That certainly would be moving the Fed in the wrong direction. As for what this means for the Fed, I think it continues to put them in a conundrum between a rock and a hard place, where both sides of their dual mandate are seemingly coming into conflict, right? The hawks have been saying we need to wait and see whether tariffs create inflation that's going to be passed on to consumers. Today's report, as far as businesses are concerned, looks like we're starting to see the whiff of that. The question is, does that get passed on? Right. The president has said, no, foreign governments, businesses are paying for this. Goldman Sachs has said businesses are paying for 64% of this right now, but it's going to get passed on to consumers. So maybe this keeps many of those folks who are in that wait and see posture continuing in that posture. And then on the other side, right, we had that weaker than expected jobs report, and we have folks like San Francisco Mary Daly coming out and saying, I'm worried about the trajectory of the job market more than inflation. So I don't think that this report solves anything this morning.
No, it definitely doesn't solve anything. Doesn't make anything easier. I mean, of course, the other question, you guys, is, if we are seeing the pressure on wholesale, if they're not passing it through, what we've been hearing all earnings season is that earnings are holding up better than estimated. Well, where's that margin hit? Because that's going to be coming home to roost at some point. I mean, obviously, we're talking about the numbers for July, so most of that is not captured in the earnings that we have just gotten for the second quarter. But it's something to think about and consider here. So what's also interesting, Jen, is we're not seeing at least Fed Fund futures budge that much this morning. That is not the sum total of of interest rate expectations, but it is a snapshot.
Yeah, it is interesting that we're holding at 90% plus and above. But again, I think it's almost like the market's trying to force the Fed's hand. And we do know there's volatility in this reports. So we'll have to see. We're going to get another CPI. We're going to get another PPI before September. But I think also I'm reading this morning that you didn't just see the good side of PPI pop up. You saw the services side as well. And we heard from Chicago Fed President Austin Goolsbee yesterday. And when he talked about the CPI number, he said what concerned him about that was that services increased. So if we are seeing inflation increase not just on the goods side, but on the services side, that's going to be concerning for the Fed. They're going to need to see more reports, right, before they make any determination on that. But if it's clear that inflation is not staying in the goods lane and it's spilling over to services, which is what the Fed was concerned about before we saw inflation coming down, before this recent rout popping back up, then that's something to look for.
And Allie, of course, it's not just Fed funds futures. We can look across the spectrum, and we definitely saw stocks react negatively to this.
Yeah, stock futures falling across the board here. And it is interesting to see those Fed fund futures still hovering around that 95% when it comes to expectations for rate cuts in September, because normally that's correlated to what we see in the stock market. I'm looking at bond yields right now, too, and the 10-year yield is still low, hovering around 4.2%. So we're not seeing this massive recalibration of rate cut expectations, but we do have a wide range of dispersion when it comes to what Wall Street thinks is going to happen, when it comes to what actual FOMC officials think could happen. And that's because, as Jen was alluding to, the Fed is really caught between its two dual mandates. And even though we did have a better than feared CPI print, let's not forget that core services did firm up. And that's what I've been hearing from my sources, is the fact that we have services inflation that's now firmer. That can't offset any increases we see on the goods side due to tariffs. And like you were saying, Julie, we have heard from businesses throughout this earnings season that they're absorbing a lot of these costs. But from the early commentary on Wall Street, that's only going to last so long. And eventually that has to get passed on to the consumer price index and to our actual wallets. So that's something to look out for in the fall and even into 2026, because that's what economists have been telling us. We're not going to see this tariff pass through right away. It's going to take a longer time. And I think markets got a little too excited after that CPI report the other day that maybe we won't see that impact fully materialize. I just think from this hotter PPI print, that might not be a reality.
Yeah, I mean, what we've been hearing from companies is they've been managing this, right? They've been negotiating with their suppliers so that they maybe split the cost of this. In some cases, they've been cutting costs elsewhere. But the question remains how far those levers can go. How deep can they go? How long can they last? And then there's the backdrop, Allie, which we have to talk about for stocks as well, right? Where we're coming off of another record close for the S&P and the NASDAQ. And the question of whether things are getting toppy here.
Yeah, and that's been a question for a few weeks, right? We are in a risk-on market. S&P 500 hit its 17th record close of the year. The NASDAQ is at number 20, and there has been this conversation about whether we are getting too frothy, whether things are too speculative. But if we look across the research that's available on Wall Street, different types of indicators, we are not at those levels yet. And Nick Colas from Data Track Research, he had some great insights earlier this week. He looked at S&P 500 sector correlations, and that showed we are not yet at a speculative high. And Colas did use this information to call the tops in 2024, in 2023, along with that February high that we saw earlier this year. So that is a good indicator to show us where things stand. Citi's Levkovich Index also tells a similar story, despite hovering at those euphoric levels. And I spoke with Citi analyst Drew Pettit about this a few weeks ago, and he told me markets often can trade at these levels for some period of time. And at the current moment, we are not too detached detached from the fundamentals. We are not too detached from the fair value of the market. Another thing he told me is that bull markets don't die of old age. There has to be a catalyst. And it seems like right now for markets, there are more upside catalysts than downside. That doesn't mean that there aren't risks here. And often when we have stocks trading at records, when we have these euphoric levels, that makes the drop that much more extreme. So markets are vulnerable. We could see some chop heading into the fall. There could be some volatility, but I would point to just next week, I believe, is Jackson Hole, and Fed Chair Jerome Powell is going to be speaking, and he's often really good at telegraphing what the Fed is thinking right now and where he sees the future of interest rate cuts. So I expect markets to really be concentrating on his commentary there.
And Jen, finally, want to come back to you on, again, the idea of the dual mandate and how we should be putting all of this data together.
Yeah, Julie, I think it's really important to take a step back, right? We got this hotter than expected number and everyone's going, oh no, what's going on with inflation? But there's two sides here. There's the job side and there's the inflation side. And I don't think you can take either in isolation. And we did see that weaker than expected jobs report for the month of July. If we get another weaker report in September for the month of August, I think that's going to raise questions of what is driving the weakening in the job market. Is it because hiring plans have been on hold as employers look for greater certainty on tariff rates, which we are starting to get now, and in which case could we see a rebound in the job market later in the year? Another point would be how much of this is the impact of immigration. If there are fewer people coming into our country, there is a lower labor demand, then maybe it's just a lower break-even number. If, however, it is a weakening in the economy, then it begs the question of, do we even have a tariff inflation problem? Because if people don't have jobs, they're not spending, we're not going to see inflation.
It feels like a damned if you do, damned if you don't situation, but we'll see. Allie, Jen, thank you so much. Appreciate it. The crypto rally derailed. Bitcoin is coming off record highs after that hotter than expected July PPI print, but the token is up roughly 30% year to date. Yahoo Finance senior reporter Ines Ferre here with more on Bitcoin and the crypto rally more broadly. Hi, Ines.
Hi, Julie. Yeah, the crypto rally fueled by also expectations of looser monetary policy coming. But nevertheless, look, this has been a massive rally this year because of institutional adoption. I mean, we used to talk about crypto when it came to the retail investor, but now we are talking more and more about institutions. You have corporations that have been following the strategy playbook of adding Bitcoin to their balance sheets. I do want to point out Bullish, the company that just went public yesterday, the crypto exchange that is geared towards institutions, by the way. So Bullish had closed at $70 per share. They priced their IPO at $37 per share. So you can just see the investor appetite for anything that has to do with crypto. Also want to mention Ether, the native coin of Ethereum, that has been near record highs as well. And Tom Lee of Fundstrat basically pointing out that Wall Street is building its projects on Ethereum, that stable coins are on Ethereum as well. So you have a lot of interest for Ether as well, and also corporations which are as well adding Ether to their balance sheets. And the tailwinds that this industry has been having from the government are unprecedented. I mean, these are what Tom Ise earlier this week had noted to us, fundamental changes. You have the government that is pushing for crypto. You have the initiative for 401ks from President Trump. You also have the SEC announcing the crypto project as well. So you have all these initiatives from the government. Even Scott Bessent this morning was on an interview with Fox Business saying that the U.S. is going to stop selling its Bitcoin reserves, those Bitcoin that they have that are confiscated Bitcoin, that those are now worth about $10 billion or $15 billion. Julie.
Ines, in another sign of the cryptoverse, so to speak, we saw a big IPO from a company called Bullish yesterday, which is the parent company of CoinDesk, among other things. And I believe, last I checked, it still had some momentum this morning.
Yeah, that's right. It is up about 5% in pre-market. It was about 12% higher in pre-market. Look there, 7.5%. So again, this enthusiasm for anything that has to do with crypto, and also the IPOs that we have had this year, when you look at what Circle has done as well, it has been a blockbuster IPO. Bullish wants to also get into the U.S. market because it's a crypto exchange for institutions in the abroad, but they have big backers, and there's just a lot of enthusiasm for this company. So IPOs have done well, and these top tokens have also done well in this rally.
Yes, I guess the rising tide, all boats, all of that. Ines, thank you very much. Appreciate it.
Thank you.
Coming up this morning, full market coverage. Plus, we sit down with the CEO of CoreWeave to discuss the state of its business and the outlook for artificial intelligence. You don't want to miss that. Now time for some of today's trending tickers. We are watching Tapestry, Birkenstock, and Coherent. First up, luxury brand Tapestry's annual profit outlook fell below analyst expectations, due in part to tariffs. The Coach and Kate Spade owners' earnings per share outlook anticipates a 60-cent impact from those levies, representing about $160 million in extra costs this year. That's according to the CFO. The company also sold shoe brand Stuart Weitzman after weak revenue generation. Now leadership plans to focus on turning around Coach and Kate Spade. Coach sales accelerated during the most recent quarter, and Tapestry CEO said a reset of the Kate Spade brand is underway. Next up, Birkenstock's adjusted earnings for the most recent quarter were stronger than anticipated. The German shoemaker capitalizing on strong demand from retail partners during the 3-month period. Birkenstock also successfully raised prices on its sandals and clogs in an effort to offset the impact of tariffs. For context, the company makes almost all of its goods in Germany. The company's CEO says he plans to capitalize on the recent momentum and capture more market share as trade wars and supply chain issues impact the broader footwear industry. And finally, Coherent shares are under pressure after the semiconductor maker's fiscal first quarter forecast came in line with estimates. The company also announced it planned to sell its aerospace and defense business for $400 million to private equity firm Advent. Coherent sees revenue in its upcoming quarter between $1.46 billion and $1.6 billion. Analysts were looking for $1.55. Bloomberg Intelligence's Jake Silverman wrote that the inline outlook was, quote, disappointing given the backdrop for AI spend. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. U.S. stocks are pulling back from record highs after the S&P 500 closed out its 17th record this year. But technical indicators do show the potential for downside ahead. Would it be a buy the dip opportunity? Joining us now, Adam Turnquist, LPL Financial Chief Technical Strategist. Adam, I want to start with the action that we're seeing this morning, actually. We got that PPI, the wholesale inflation report, coming in considerably hotter than expected. You put that together with record highs, and you've got futures down this morning. So what does that sort of setup look like to you?
Overall, when you look at the technical setup, we're pretty overbought on the S&P 500 right now. We actually had called a doji candle. I'm not going to get too far down into the weeds of the technicals yesterday, but oftentimes those are found at inflection points, and it's all about the follow through. Today we're getting, looks like a weak open for now, and not to sound bearish, I do think it is a buy the dip opportunity. You think about the market overbought. You look at even today's inflation report coming in hotter than expected, and where we're at seasonally as well would make sense. Maybe we're due for a little bit of a breather here in this bull market.
Adam, I know one of the indicators you watch is the 200-day moving average for the S&P 500, and the space between, if you will, the premium at which the S&P itself is to that 200-day moving average, which is just a momentum indicator for people who are watching at home. And the gap there, pretty wide. We're showing it here. And with that takeoff on the right side there, with the S&P continuing to push to record highs, you've got a pretty good gap there. What does that tell us?
Right now, we're at about a 9% premium above the 200-day moving average. The easiest way to think about that is a rubber band, and price being the rubber band above that moving average. It generally only goes so far before you start to see either a pause or a pullback. That threshold is about 10 to 15%. That's kind of the peak premium you'll see in that indicator. And we're getting close to those levels right now. And it doesn't mean that the market is going to roll over or a market top is being made. It is really just signs of the market getting a little bit extended and maybe due for some, at minimum, a consolidation phase.
So you've said something a couple times, or sort of indicated a couple times, you don't think this is the end of the bull market. You think that, if anything, there might be a little rockiness, a little pause. How do you know the difference, right? How do you know when the market is setting up for some rockiness or maybe a small pullback versus something more significant?
We look at a range of different indicators, of course, the macro environment as well. And I think just on the technicals here, we have very cyclical leadership. We have semiconductors leading. We have areas like industrials, financials, all doing quite well. That's the leadership you want to see in a sustainable bull market. And breadth, even though on a short-term basis has deviated a little bit from price action, still remains constructive. You have over 60% of the S&P 500 above a 200-day moving average. Same type of stats in our proprietary trend model. So underneath the surface, on a longer-term basis, it does look pretty constructive. Not to mention the macro environment. We have yields moving lower. The Fed likely going to start cutting rates in September. So I do think that does support a more durable bull market, although we know bull markets are not linear, so we have to expect some volatility here in the next few weeks, we'll call it.
Adam, I want to talk earnings for a moment, because if you take this morning's producer prices, you put it together with consumer prices, that indicates there is tension somewhere, right? Because wholesale is rising faster than consumer. So does that mean that the earnings, honeymoon that we have been on for this reporting season, that's going to come to an end when we start to see that margin pressure?
It's hard to bet against the corporate S&P 500 earnings right now. Corporate America continues to surprise all of us with the resilience. We were expecting earnings around 5% for the quarter for the S&P. We're going to do at least double that. The beat rates are above average as well. And I think what you'll hear, or what you're hearing at least from the C-suite right now, is how they're navigating around tariffs. I don't know if they have enough indication on where and how much tariffs are going to be. We're just starting to see the effect of that, and it hasn't really, those pass-throughs have not shown up. We definitely saw that in the CPI report over the last couple months. The more forward-looking wholesale inflation, definitely a concern, but I do think that's going to be the big question this fall, is how those tariffs show up. Is it going to be on CPI or PCE, or is it going to start showing up in margins? Right now, we haven't really seen a big margin hit, absent today's earnings report from Tapestry, what you were talking about earlier. But maybe that's what's to come, and maybe we'll weigh a little bit on the earnings growth story we've been so reliant on here.
Yeah, TBD, as are most things in the market. Adam, thank you very much. Appreciate it.
All right, thanks for having me.
Coming up on Yahoo Finance, we got opening bid. Our own executive editor, Brian Sazzi, is joining us now. Saz, what do you got on tap?
We're going to continue to drill into that producer price index, Julie, which at least temporarily has poked a hole in that bull narrative that we're going to get a bunch of rate cuts into year end. And then in our power player segment, Cisco's new CFO, Mark Patterson, is in the house after the company's earnings report. Some squishy areas I need to ask about Mark from that report, but nonetheless, Cisco CFO, we'll dive in there.
Looking forward to it. Thanks, Saz. That does it for Morning Brief. Much more ahead on Yahoo Finance.